And without further ado, I'm here with Josh Linkner to talk about Mudita, the venture fund with a soul. I know you're all curious, as am I, as to how a venture fund can have some soul, but we're excited to hear. Josh?
Well, thank you so much. Great to be with you today, everybody, and appreciate your time. I thought I'd begin, just give you a quick overview. Not going to take the whole hour, of course not, and then really just get into some open dialogue and Q&A. Venture fund with a soul. It sounds like an oxymoron, sort of like like Jumbo Shrimp or Seriously Funny or Microsoft Works. Sorry, I just couldn't resist that one. No, kidding aside, we will explore that, and it's not just about doing positive good in the world. It's also, of course, about driving important economic outcomes. So let me give you a little bit of a tour here. There it is. Okay. First question you're probably wondering is, what is this weird word mudita? Mudita is a Sanskrit term, which means taking joy in other people's success. Many venture funds are pretty ruthless, and we believe that kindness, compassion, and generosity are actually accelerants to growth and success. It's a feature, not a bug. And so we're absolutely outcome focused. We are not soft, but we're doing it in a way we're lifting people up instead of kicking people down. And internally, we have our own mandate to ourselves to deliver $1 billion of return to investors while simultaneously delivering $1 billion of good to the world. We measure both. We measure investor returns, obviously, in things like DPI and MOIC and IRR and all that. But we also measure positive impact, something we created called the Soul Score, which is measuring the impact that our companies create on humanity. All right, let's get right into it with a couple Fund 2 highlights. We are in the middle of Fund 2, which is a $125 million fund, and we have raised $93 million of that so far. And then we are seeing some really strong momentum here. We're on track to deliver about a 35% IRR and a 6x TVPI. You know what? I'm going to pull out of this. I think I got the wrong deck here. Hang on one second. Sorry about that. In my enthusiasm, I grabbed the wrong deck, so let me just grab the right one. Give me 2 seconds. Sorry about that. This is the soul part coming through here when you botch a PowerPoint.
It's all good.
All right, there we go. Let's get this running, and I apologize. Okay, so as mentioned, we raised 93 today. That's why it caught me. I was wrong. We're forecasted to deliver about a 35% IRR in Fund 1. So we're coming off a very strong Fund 1. I'm going to go to some details there in a minute. But we're expecting
You're
Fund
not
1.
sharing your screen right now, just so you know.
Not sharing the screen. There we go. Hold on one second. Apologize. It looked like it was sharing on my end, so let me fix that. And we'll get this rolling here. Luckily, I'm better at building companies than I am at running PowerPoint slides, so give me one more second. We'll get this figured out. There's that screen share. All right. What are you seeing? Nothing? Nope.
We did for a hot second, and then it went back.
All right. Well, that's a little odd. Let's give that another shot. Of course, it's not letting me share that. That is very strange. Sorry, everybody. I apologize. Let me try closing this down and open it back up. It did. It shared for a second and then stopped, right?
Yeah, I have a message that people can see the two of us, but not your screen. So
okay. Well, worst case, we'll do an unplugged version, but it is more fun with some visuals. So let me see if I can get us back to that. Sure. Why? It's funny. I've done about 1 billion Zoom calls, so naturally, this is the one time it's not working. We'll try this one more time.
there you go. It's starting.
All
There.
right. Sorry about that, everybody. Okay. No, that's the wrong one. Let me try this one more time. I apologize, everyone here. My PowerPoint's acting weird on me. All right.
There we go.
All right, there we go. Sorry, everyone. Let's keep rolling. So as mentioned, we're coming off of strong momentum of Fund 1. Fund 1 was a $44 million fund. It was oversubscribed. And the interesting part is that we have some strong momentum. We're expecting to deliver about a 31% IRR. And we're expecting about a 1.2 DPI by the 4th anniversary of the fund. And so we're not only driving strong performance, we're doing it in a compressed time frame. We focus on AI companies, as many others do, but really focus on B2B software that are helping companies embrace the future of work. So it's not just, we're not doing consumer products. It's very much focused on B2B. And the allocation is interesting. So we have an 80% allocation to companies that are post-revenue, pre-growth spurt. So the theory there is invest before escape velocity. There's an interesting band of risk and reward there. It's not as early as and risky as an idea on a napkin, but it's also not overpriced. So there's this band of opportunity, sort of pre-A and getting into an A round that we like a lot. And the theory is that we go in there and help them aggressively accelerate, help them hit escape velocity, and then pull our capital out pretty quickly. The other 20% of our allocation goes to something called our venture studio. Many of you may be familiar with this asset class, but essentially we're the investor and the inventor. I'll get into more detail, but we have a pretty robust laboratory where we invent companies, prototype them, and then launch the ones that have deep conviction. So it's an 80-20 split, 80% post-revenue pre-growth spurt, 20% venture studio. Unlike others in our asset class, we have a very short hold period. We target 3 to 5 year hold periods for our investments instead of 8 to 12 years. And our theory is there's so much risk and volatility in the world. We like to get in, generate momentum, pull capital back, and we believe that drives IRR for investors. And we're active participants. We're not just writing a check and hoping for the best. Our work begins not ends when our first check is written. So quick introduction to the team. Every one of us has real deep experience, not just as financiers, but as operators. Personally, as we're getting to know each other, I've started, built, and sold 5 companies of my own. I was the sole founder and CEO of each, M&A on both sides, thousands of jobs created, exit values over $200 million. I've also started, I started first venture fund in 2010. We started Mudita in 2020. And so I've had a lot of experience on the other side of the table investing. Also have written 4 books, some behind me, on the topic of innovation and creativity. So I'm out there in the world kind of as a thought leader. And another fun fact, I'm a professional level jazz guitarist, which explains my background. I started the fund with my brother, Ethan, who's also a well-recognized entrepreneur. He started bootstrapped and sold a company for $50 million, which is good. He's been a strong investor and board member. Our third partner is in Chicago, Josh Tolman. Josh Tolman is a proven guy, CEO, CTO, Chief Strategy Officer. His last gig as a CEO, he delivered an 83x cash-on-cash return. And then our fourth partner, Sandy Schwartz, he spent a career at Cox Enterprises. He was the CEO of Cox Automotive, which was a $7 billion division. And most recently, he was the CEO of the Cox Family Office, which is a multi-billion-dollar family office. So these are the 4 principals, the four members of the investment committee. I don't have slides for every one of our team members, but you get the idea. We're all operators by trade. We also have a pretty extensive extended bench. So we have strategic advisors and operating partners. We use these a little different than other venture funds. They're much more active and engaged. So just to give you a little flavor of it, these aren't all of them, but Janet was the former CEO of Deloitte Consulting, and previously she was the chairwoman of the board of Deloitte. Alan Ying is a former cardiothoracic surgeon. He was the former chief medical officer for Thomson Reuters. He's been a multi-time health tech CEO, multiple exits. He's been in private equity. Jeremy Bacon, multi-time post-exited founder and CEO. He's a professor at the University of Chicago School of Business. Anjali, who's a former founding general counsel of Warby Parker and former chief people officer and general counsel of Cheddar, on the board of governors at Brown University. And last but not least, just sharing a few of the many, but Michael Lazaro, serial entrepreneur. He sold a company for $745 million to Salesforce, among others. He's delivered over $10 billion in investor returns. So my point is that we have some serious people with operating capacity around the table. All right, so I want to focus our quick conversation, then we'll get into plenty of questions around 4 key differentiators. Question isn't what makes us the same, but what makes Mudita a little different. And there's 4 key advantages: sourcing, innovation, risk mitigation, and growth. We'll touch briefly on each of those. Sourcing. I feel like many venture funds are competing for the same overpicked, expensive deals. In our case, really searching for uncommon deals through uncommon access. One of those access points is I do a lot of keynote speaking. Despite my bad PowerPoint skills today, I've done about 1,400 keynotes around the world, and I've developed core relationships with hundreds of C-level executives at big companies. This is generating not only good relationships for our fund, but deal flow. Some of the deals that we're most proud of came out of these relationships, and these are a place where other venture funds aren't exactly playing. Let me give you a quick example. I did a number of keynotes for a large accounting firm called Crowe, C-R-O-W-E, And I got to know them really well. They had this technology project internally that was really powerful, but stuck inside of a big accounting firm. Essentially, it's called K1X, which is an automated way to do K1s, the bane of many of our existence. I'm sure everyone on this call hates K1s because they basically suck. They're always late, they're expensive, they're manual in nature, they're prone to error. So they spent $30 million building this really sophisticated AI system to send and receive K1s at scale. The problem is it was stuck inside of an accounting firm. Because of my relationship, I was the only investor at the table. I was able to buy this asset out and then build it up. And I just want to give you a sense of this timeline because it gives you a sense of how we think and work. So first, we bought the asset out. I was able to get a little seller debt, which created leverage. I also raised $15 million of outside capital at a real-time arbitrage at a higher valuation. Long story short, when the dust settled, we put $1 million of our capital to work, and we sold almost a 40% stake in a company worth $52 million. Not a bad start. But again, for us, the start is just, well, the start. Within months, I helped them personally recruit a new CEO, new chief revenue officer. We helped them rebrand and change their narrative. Within the first year, we helped them raise an additional $6 million of capital, recruited high-profile board members, such as the former head of the IRS. Company ended their first year with 100% year-over-year growth. We made significant introductions to potential acquisition partners in their field. And here's where it gets fun. In August, so about 2 years and 3 months later, $20 million Series B came in at a much higher value. We pulled 2.25 out. So remember, we put in one, we already got back 2.25, over 100%, obviously, DPI on this investment. But we sold a 22% stake in the business, and the company's well-funded and continuing to scale. Last year, they ended with a strong 60% year-over-year growth. And we're expecting the company to end this year about $25 million in ARR, which will put the company valuation somewhere between $200 and $300 million, and our remaining stake between 44 and 66. So if you look at this holistically, between time of investment and the end of this year, we will have put $1 million of our capital out and have created somewhere between 46 and $68 million of returns in a 3.5-year time frame. Now, this is an outlier. I'm sure they won't always be this good, but I just want to give you a sense of the way we think and the way we work. Uncommon access to deals and deep support for those portfolio companies as they scale. Other sourcing advantages that are a little different than most, we pursue blue ocean markets. Nothing wrong with either coast. Obviously, love people in both coasts, but I live in Detroit. We have people in Ann Arbor and St. Louis and Pittsburgh. And so the idea is we even like there's a geographic arbitrage. You can buy at lower valuations in these sort of secondary markets and then ultimately sell to a coastal valuation. We love looking for off-market deals through our professional network. These can be secondary buyouts, corporate spinouts like the one I just described. We'll call them rezoning deals where maybe it's a services company that we can flip into a software company. So these are sort of, again, a little weird and different than most venture funds, but very effective in terms of creating return. We have a bench. I shared a few of the examples, but a pretty deep bench of not only the operating partners that I showed you, but more of those, more strategic advisors and venture scouts. So essentially what we're doing is we're tapping a much more expanded area of professional network to drive uncommon deal flow to the fund. And these are a little more typical. We have partnerships in place with 30 other venture funds and 6 major research universities to flow deals into us. So again, there's no shortage of deals, which allows us to be extremely selective. Our selectivity threshold is under 0.5%, which means that we only fund under 0.5% of the deals that we look at, which means, again, we can say no a lot to the good ones to say yes to the great ones. The other thing I'll just share quickly is that we're seeing it time and time again, entrepreneurs wanting to be on our cap table. Even oversubscribed funds, the entrepreneurs are carving out a piece for us because they know we can be a helpful accelerant to their growth. All right, so that was deal flow advantage. Let's take a quick look at innovation advantage. Many venture funds' primary job is to be, financiers, which is, again, nothing wrong with that. But our definition is a little bit broader. We think of ourselves also as innovators and business builders. Again, I've written 4 books on the topic of innovation, and all of us have started, built, and sold companies. So we wanted to bring that as an asset to the fund. The way that manifests is something called Mudita Studios. It's a separate standalone studio, we like to say on the front lines of innovation. So this venture studio, basically what it means is this. When a deal comes into the studio, we are the investor still, but also the inventor. Think of it as the funder and the founder. So what this is defined, it's a standalone studio. Think about like a factory. The inputs are raw ideas. The outputs are fundable companies. In between is a very rigorous stage gate process. Most ideas don't get all the way through. We do technical feasibility studies, prototyping, market analysis, competitive review, financial modeling. So again, most deals don't get all the way through, but the ones that do, we then hire high quality management, staff that reward them with equity, launch the company and go. And the real notion of this is that we are decoupling what normally is an entrepreneur, which is an idea, and the person that's going to run it. Because sometimes the person with the best idea is not the best person to run it, or vice versa. May have a better operator than the person with the idea. And so by decoupling those two, we get better quality, but also better deal terms. We have a significant economic advantage. The other thing I'll share is that we built very sophisticated AI tools that have accelerated the studio process. AI is helping us generate new ideas, helping us do prototyping, validation, writing code. So we're able to get a very high number of ideas through the process to weed out the bad ones to get to the absolute best ones. So the studio advantage, just to give you a better sense of this. Today in Silicon Valley, the average seed valuation is $12.8 million. If I were to check into that, let's say I wrote a $1 million check, I would own 7.2% of that company. Studio company, I start by owning 100%. Then I give some equity away to professional management to help us run the company. But let's say on day one, I still own 70% of the company when we fund it. Think of the difference. I'd much rather own 70% than 7.2%. And what this allows is not only obviously tremendous upside, there's even downside protection. Imagine the scenario we had a pretty mediocre outcome and we sold the company for $10 million. I would still have a 7x cash on cash return, even though a $10 million exit in totality is not that great. So again, it protects both the upside and the downside. The other thing is there's an executional advantage because in a studio deal, we control the board. We're hand selecting the management. We're not subject to entrepreneurial problems, et cetera. So it's those two coupled to drive performance. And I'll send everybody this deck when we're done, but these are outside. This is from an outside report, not ours, but studios are actually outperforming the general venture asset class. If you look at the things that investors care about the most on that chart on your right, IRR is double. Total value to paid in capital is 4x. There's also a timing advantage. So what we're seeing is that studio deals compress time and boost value. Okay, risk mitigation. Everybody's concerned, and mine too. By the way, we're pretty thoughtful on this regard. My complaint about many venture funds is they swing for the fences with every pitch, and our preference is rigor over wild swings. Maybe it's our Midwestern roots, I'm not sure, but we take a real disciplined approach to the work that we do. First of all, it's a philosophy around capital preservation and risk mitigation. We just don't do wild bets. We only fund companies that have an asymmetric risk reward profile. In other words, we have to believe in our hearts and have conviction that there's at least a 50% or higher chance of delivering a 5x cash on cash return, coupled with a less than 10% chance of losing any capital whatsoever. It's a high standard, higher than most. And if it doesn't pass our criteria, we'll say no. Another venture fund might say yes. But again, we're wildly selective in our approach. We also built structural risk mitigation into the system. There's a single member veto on the investment committee. So it takes a majority to say yes to anything, but a single member can kill a deal. And this provides extra safeguards. If anyone just has the wrong feeling, we'd rather pass on a good deal than say yes to a bad one. And finally, our philosophy in this, we believe many of you have heard of the power law, which is basically, make huge bets. Most won't work, and every now and then you get one that carries the whole fund. We believe in this kind of idea of a new power law, which is base hits over grand slams. We're not over-indexing to a small number of wins. We're trying to have a wider distribution. We're still preserving the opportunity and upside of a big one, of course, but we're not relying on that. A couple other thoughts on risk mitigation. Many venture funds are too quick to cut bait, in my opinion. The minute something goes wrong, they just kill it. And sometimes you have to make a tough decision, which we are prepared to do. But in our case, if your kid is sick, you don't get rid of the kid. Maybe you can help restore your company to organizational health. And so we actually built this thing. It's unique to venture. We call it the Mudita Clinic, which is using a healthcare metaphor. It's a robust system to nurture back to health companies that are struggling. 3 steps: triage, treatment, transition. Triage, we do a rapid diagnostic. We take a look at the patient's vital signs, which are a bunch of things like ARR and churn and a number of other factors. And we do then build a prescriptive treatment plan based on the severity of the required intervention. Next is treatment. We build a critical care team that could be internal folks, outside advisors, And we really get right to the heart of the problem. We try to remediate as quickly as possible, get it out of the clinic. And then there's this ongoing transition period where we're continuing to monitor the vital signs, to continue to make sure that there's been it hasn't reverted to the mean, that the essentially the intervention is holding. Just to give you a sense, in our first fund, there we preserved what I believe to be $3.1 million of capital that other venture funds would have taken a zero on. But we were able to restore that capital back to health. So it won't work in every case, but it will work in some. Finally, growth advantage, and then I'll be tossing it back to Q&A here in a minute. But once you have a portfolio company, we believe it's our responsibility to facilitate the acceleration of growth. Many venture funds kind of promise to add value. They don't always do it. In our case, we actually do the work. So the growth playbook that we've developed is sort of this in the trenches area where we help. It's a proprietary system to accelerate growth, drive value, optimize long-term returns, long-term investment returns. And it's actually a double economic advantage. First of all, we're actually getting better deal terms. So I've been side by side with other professional investors, and a company will give us extra warrants or extra juice in the deal because we're providing more value. So we're getting better terms up front. And then, of course, to the extent that work is successful, it drives long-term terminal value. So those are compounding double economic wins because we provide this service. And I won't go into the detail, although I'm happy to share this as much as you want. But we developed this proprietary Mudita growth playbook. It's actually a button down in the trenches. Each of these components there's dozens and dozens of things underneath it, but we help companies build a real plan around sales and marketing, customer obsession, product vision and roadmap, tech and data, leadership development, operational foundations, financial controls. So all the areas that people have scraped up their knees, including me over the years, we've built this sort of checkbox system to help our portfolio companies accelerate growth and mitigate risk. Simply put, a company with this playbook versus one without it is going to perform better. Okay, so just wrapping it up, Fund 1 performance, because you obviously need to judge our report card. Here's where we are. The current performance of Fund 1, we've deployed $25.3 million of capital into 24 companies. The current fair market value is about $78 million. So that means today we're sitting at a gross multiple on invested capital of 4.3. Net TVPI, so obviously after expenses and such, about 2.3. And we've returned capital. We've had 2 liquidity events so far. We've already returned 13.5% of the fund. And just to give you a sense of timing, we made our first investment in mid-2022. So again, 3.5 years, that's where we sit. The net IRR today is about 40%. We ran a whole bunch of different forecasted scenarios. Think of it like a Monte Carlo scenario. We ran highs and lows and all that kind of stuff. And here's where we expect the fund, plus or minus, to shake out. We will deploy about $32 million after fees and expenses. We expect a realized gain total of about 216, gross MOIC of 7, net TVPI of 4.5, which will yield a net IRR of about 31%. Again, these deals are still in flow. It may be a little higher, maybe a little bit lower, but we have real conviction that the systems that we built are working, and we expect them to continue in Fund 2. To give you a sense, that's sort of the new power law I was talking about. These are where we expect distribution. So if you look at the top line revenue multiple, 0 to 1, 1 to 5, 5 to 10, a normal fund in Silicon Valley will overweight on the bottom. They're expecting their returns to come from the 1 or 2 deals that hit it out of the park. In our case, we're not expecting that at all. We're expecting distributions to come in a much more balanced way. Many of those much more modest returns. So the fund performance is we're not betting on and requiring a giant unicorn in one company. It's more distributed than that. Okay, last slide. Just real quick recap of the investment opportunity itself. As mentioned, it's a $125 million fund and typical 80-20 split, 20% carried interest. The fund term is a 5-year investment period. We're only investing in new companies over the next 5 years with a 3-year harvest period following that. Fees are 2.5 and 1.5. So you might call it a blended 2, but there's a reason behind this. No one's getting rich on fees, by the way, but those fees are covering the overhead that we need to fully support those companies in every aspect of their growth and performance. The minimum capital commitment is $500K. But the capital pacing is a little interesting. Instead of calling all of that or being subject to sort of random last minute capital calls, it's very deliberate. 20% due on close and then 20% each year. And so it's very predictable. We will never deviate from that. It's 20% a year for 5 years. And as you remember, the hold periods are short, 3 to 5. We've already started returning cash in our previous fund, which were only 3 years after first deployment, which means that we expect the distributions from vintage year one to offset further capital calls, meaning that whatever capital overall commitment is, you shouldn't end up having to put all that money out because you'll be receiving distributions back along the way. I'll also say that all of the partners have invested personally in the fund. Just so I put 1.5 million in Fund 1 and Fund 2, and that's on the exact same terms. So we are all fully aligned, shoulder to shoulder. The benchmark is 1% of a fund is taken by the managing partners. We have over 5% in our case. So putting our money where our mouth is, and deep belief in the business. And that's where I'll kind of end it and open up for questions. I really hope that we get the chance to make the world a little bit better together, driving both meaningful economic returns and meaningful impact to humanity. So thanks for listening. Sorry I talk fast, and sorry that I have a poor PowerPoint game today, but I'll stop sharing and we'll get into some good conversation.
Well, we actually had a few questions pop up while you were zipping through that. First one came in and says, so what is the duration of long-term investing in your view of the world? Thank you very much for the kind intervention. Do you agree with the ideas of FCLT Global, or did you prune their philosophy out of your mindset? Really impressive work, and I really appreciate the listen. From Hansa.
Cool. So one question was on hold period timing. As mentioned, we really like the 3 to 5 year hold period. And for us, it doesn't mean that the company has to have that's their ultimate exit. If we are essentially passing the baton to a new investor and a recap, that's okay with us. Just as time goes by, you get further away from your original thesis. The world's changing radically. So we like the idea of kind of coming in and out. So we're pretty committed to that 3 to 5 year hold period. That being said, we're not going to be stupid. So in year 5, if it's just not ripe and the market conditions stink, we have the ability to go a little bit longer, but we're trying hard to hold that hold period. The second part of that question was, our philosophy on, I think you were asking about the power law. Is that what the question was?
Do you agree with the ideas of FCLT Global, or did you prune their philosophy out of your own mindset?
I'm actually not familiar with them specifically, but my hunch is that's more of that sort of power law thinking. And look, I have deep respect for I'm not putting down any of the most incredible funds out there, of course not. But we do things a little bit differently. And I don't believe that venture funds in general need to take as big of a loss ratio. If you look at a typical fund that has 10 investments, they bet that one of them is going to be a breakaway smash unicorn grand slam. 3 or 4 of them will basically break even and the rest will die. And we don't think that that's required. We're trying to take a fresh and new approach to venture that's a little bit more disciplined, a little bit more rigorous, and a little bit more, not these erratic swings.
Another question came in. There are many AI companies that are not being wiped out with each and every update from major giants like OpenAI and Meta, because whatever the startup has spent time and money to build, these giants are giving it in their next update. How do you plan to overcome this?
Yeah, it's a great question. And in fact, there are companies that we have invested in and will invest in that sit on top of an OpenAI, for example. We ask that question tirelessly, which is is it a feature, or is it really should be a separate company? So we say to ourselves very deliberately, like, what would happen if GPT just added this as a feature? And so we have to look for a moat of protection against that. That can either be a customer access and a revenue moat. It also can be a data moat. So it's the data, proprietary data that we capture that sits on top of AI, but is not germane to it only. Or it's got to be some other, it could be user experience is the differentiator. But unless there's something that we know that we can protect, if GPT or others came out with a new feature, we will not invest.
Kim Carter, one of our club members, is asking if you could highlight your biggest hit so far with the fund.
Sure. Yeah, I think that K1 example that I shared with you, that's going to be a big win, undoubtedly. But there are a bunch of others in the fund. We've had material markups in several companies. There's a company that we got in at a very low point. We then negotiated extra warrants at half price. And so we put $1 million of capital, and it basically has like a blended average of about a $30 million valuation at investment. And today it's worth 100. And that was about 6 months of time in. So a 300% rise in 6 months feels pretty good. Many of our studio companies too, by the way, like those are still brewing because they're very early. But there's a couple there that I think have the potential to be true breakaway hits. I'm happy to walk you through an example.
The follow-up to that was when you acquire an asset, do you have a minimum ARR requirement? And then what is the typical valuation?
Yeah, I'd say requirement versus I'd call it philosophy. I mean, because you always want to give a little room if you need to bend a little. But generally speaking, we invest in companies that are doing between $1 and $4 million in ARR. I mean, that is like the 99% of the bell curve is in there. Again, we like that because if you're doing $1 million in ARR, you've proven you can get a customer, keep a customer, you've proven some product market fit. It's not just like your neighbor is your only customer. So there's something right going on. But if it's doing $50 million in ARR, it's going to be priced too high for us. And so we love this little band of risk reward. And actually, if you get that right, the acceleration of capital returns is dramatic, but without the general corresponding risk. So that's our sweet spot. What's the second part of the question again?
The typical valuation.
Oh yeah. So valuations in Silicon Valley can be crazy. We actually are just passing on a deal that's a pretty good deal, but it's too expensive for us. We believe in just rational thinking, and so we run multiple what if scenarios. What if valuations compress? Is this company still valuable if it shifts from a revenue multiple to an EBITDA multiple, et cetera? It's back to that base it over grand slam mentality. Our typical valuations are somewhere between $10 and $25 million pre. And then there's been a couple of cases we've gone a little bit more than that, but generally not. And also we always invest in pretty investor friendly deal terms. There's often a balanced board. We generally get a board seat. We have all kinds of investor protection provisions. We obviously have preferred equity, but sometimes that preferred equity has some juice in it. There could be a clipping interest rate. There could be a minimum liquidation preference. So it's both valuation and deal terms that we're looking closely at. It's not to jam entrepreneurs. We want them to thrive, by the way, but it's striking a balance because we're giving more, a lot of support and growth to those companies. We're getting more also in terms of valuation and deal terms.
I like how you're taking a unique approach compared to other venture funds. Rather than just following the herd, what are some of the things that you see typical venture funds get wrong?
Yeah, we mentioned several of them already. They only wild swings. I think a lot of funds have so much capital that they're under tremendous pressure to deploy. In our case, again, 125 is a manageable amount for us. Someone said to me on a previous call, "Hey, if you had 250, what would you do?" I'd say 250 sounds great, but we're not geared up to deploy that effectively. And I never want to be in a position where I'm like, oh, it's not a perfect deal, but I got to put capital out. And so that's one mistake I see venture funds making frequently. I think they also tend to be herd followers instead of true innovators. And I don't. It sounds worse than it is. I mean, there's many amazing people, but a lot of times venture is an asset class. They're always looking for what's the next venture fund doing. It's more of a copy and repeat strategy. In our case, we're really trying to take a fresh look at it and pioneer new ground. Doesn't mean we won't learn from the masters. Of course we will. But when there's areas to reimagine and rethink the approach to venture, we're not taking that off the table just because no one else has done it yet.
We have an interesting question. As an entrepreneur, we're always looking to refine how we present our ideas. When you review pitches, what stands out most? And what would you value as being a strong pitch?
Good question.
It is a good question.
One thing is, I look to see are they creating somewhere like at least a 10x type advantage. So if someone says, "Hey, I'm going to launch a new company, it's just like eBay, but it's 2% better," that was back to the earlier question. eBay could just put out a new feature release, and there's no more, eBay wins. And so to go, I guess, especially against an established sector, you really have to show some type of material step function advantage. It could be a customer advantage, a cost advantage, a people advantage, whatever. So that's one thing we look for. We look for people that are again, pioneering new ways rather than regurgitating the old ways. A lot of it at this stage too gets down into the entrepreneur themselves. So you can tell by a pitch, are they demonstrating open-mindedness and humility versus arrogance, et cetera. The one thing we don't have the perfect term for it, but we basically call it pirate energy. We actually have an entrepreneurial scorecard, which we created as like a 21-point scoring, financial acumen and domain expertise, et cetera. But the one attribute I see working more important than anything, we just call it pirate energy, which is that entrepreneurial willingness to run through a wall and win no matter what, which is this real sense of like energetic leadership and unwillingness to accept anything but success. It's tenacity mixed with grit. And that's we're seeing that as the driving factor for entrepreneurial success. I think on a pitch standpoint, though, also it's like, do they just talk at you or do they listen? Are they picking up situational awareness and other signals? The other thing is, who are they giving credit to? Is it only about themselves or is it to their team members and such? So those are some of the ways we evaluate a pitch.
We have someone who joined a little bit late and was wondering if you could just highlight your source of deal flows. I know you mentioned it briefly on your deck, maybe just quickly a little overview.
Sure, and we'll send over the deck and the recording to give you more depth, but a couple of things. We really look for unique deal flow. So one of them is that I have access through doing a lot of keynote speeches. I've written 4 books on the topic of innovation and creativity. We have access to a couple hundred C-suite executives in big companies, and that is unique deal flow that most others don't see. Another one is that we have a deep bench of strategic advisors, operating partners, and venture scouts that are looking for unique deals all over the place. The one other one I'll highlight is that we pursue we think many core markets are oversaturated, Silicon Valley, New York, Boston. And so like I'm in Detroit and we have people in St. Louis and Pittsburgh and Vegas. And so we're often looking for non-traditional geographies, which can often have phenomenal deal flow. It's less expensive to build there, it's better terms. And we create a geographic arbitrage where we buy it sort of Midwestern values and sell it coastal values.
Great. Tell us more about the Mudita Growth Playbook.
Yeah, this is, we actually, when we built this, all 4 of us signed our name on it. Like, it was not to be pretentious, but like we felt like it was a piece of art. And the idea behind it is, can you systematize the magic? Think about all the things that have to go through an entrepreneur's head to be successful. And, there's like all kinds of stuff you can read, but it's out all different places. We said, what if we put everything in one place? Almost like an operating manual for building your company. And it's not meant to be, it's the right balance between structurally sound and comprehensive, but also fluid and agile. So a company can adapt, what their needs are to this. It's not overly rigid. But it covers all the different domains that a leader needs to be thinking about, from the very basic, like, what are my financial controls and third-party, audit systems and banking, to much more abstract things like, how do I nail my ideal customer profile and product vision strategy. And so we try to, again, systematize the approaches. So number one, we don't miss anything, which can often get dropped even from a well-intended, experienced entrepreneur. And number two, as a system to accelerate growth and mitigate risk. And again, the theory is that systematic playbook is an accelerant to economic returns.
This is probably close to my heart. While we all want to do good in the world, many family offices' first priority is returns. Help me understand the trade-off between returns and impact.
Yeah, exactly right. And what we are not a social impact fund making, C-grade investments to do good in the world. We're not that. For us, it has to meet both standards. So first and foremost, it has to be an A+ investment opportunity, or we're not going to invest, no matter what. We will never sacrifice an investment decision for a social impact, period. After it meets that, then we go through a criteria in which we have to understand, okay, is it also good for the world at scale? In the same way doctors' core philosophy is do no harm, that's kind of how we think, is do no harm. And so if a company has great technology and it's going to be really profitable and it's going to manufacture French fries faster to help obese kids become more obese, we're just not investing, because that will make the world worse, not better. There's enough good out there that we can invest in companies that at scale make a positive impact in the world instead of a negative one. So it's got to meet both criteria. And just to give you a sense, if one company was an A+ investment and a B impact, the other one was a B investment and an A impact, we will never make a B investment decision. Again, just want to reinforce that. But we also make sure that there's the threshold is also met, that at scale, the company is going to do positive things in the world, that we can look our grandkids someday in the eye and feel proud that we invested in that company.
What is the minimum investment that you take currently in the fund and the minimum check you would accept?
Yeah, so it's a $500,000 minimum commitment. And as mentioned that, and I know I shared a lot, the capital pacing is 20% per year over a 5-year period. So if I use a simple example, someone made $1 million capital commitment, they are not writing $1 million check. They'd write in this example a $200,000 check. Next year would be 200. The following year would be 200. So our whole philosophy there is why hold on to people's dry powder and let it collect dust in our bank account? It's not good for you, not good for us. So we only call capital in a very deliberate way. There's never a surprise capital call. There has never been, never will be. We're all investors. We've all been LPs in other funds. And that's the thing you hate is when someone says, hey, dude, I need all this money by next week. So we don't do that. By the way, in terms of investor relations, complete transparency on everything. There's a 24/7 investor portal. We have third-party fund administration. We do once a quarter a written update. We do once a quarter a live, we call it Matters of Mudita Zoom session, where we highlight some of our investments. We talk about what's going on in the fund. So there's capital statements. So I'd say that the quality of investor communications is high, and that capital pacing allows someone to make a bigger capital commitment because you're not writing that check all up front.
Tell me a little more about what you call FYI.
So FYI sounds very benign, but here's the thing. We have this philosophy when making an investment. We say if it's not an F yes, it's a no. We say the whole word, I'm just being polite. But for us, if it's not an F yes, it's a no. So the FYI stands for the F yes index. And it's this whole proprietary model we built. It's very sophisticated and complex. I'm happy to share with anyone, and I think we have it in a data room. But it's the way that we evaluate a company. We look at quantitative measures up and down from economic modeling, competitive review. We score the entrepreneur. And so we have this whole robust proprietary system that we use as the backup of making investment decisions. It's not only that, so we're certainly using our own judgment and experience, but it's coupled with a rigorous, numerically driven, quantitative approach to investing, which is called the FYI. And so we're always joking around like, hey, what does the FYI say? And of course, that's got a funny ring to it, but we're proud of it, and it is unique to our fund.
You need to get T-shirts with that on now.
We do. Bumper stickers, I like it. Tattoos, perhaps.
Someone's asking about, well, who do you usually syndicate deals with? Any big names that often come in with you?
Yeah, well, a number of them. One that we're real close with is Edison Ventures. They're wonderful friends and partners of ours. We've done deals with, I'd have to think about a list, but dozens of other venture funds. We're pretty collaborative. In this case, both bringing in capital, they share deals with us, we share deals with them, and we have people at different stages. So we have some feeder funds, like real early pre-seed stuff that feeds into us, and then as we develop and meet companies a little bit more capital, perhaps beyond our check writing capacity, we then team up with folks like Edison that can write bigger checks. So we kind of plugged into that overall ecosystem and have lots of friends and lots of funds.
And forgive me if you already stated this, but is it strictly US based investments or are you global?
We haven't made, we've made investments in Canada. We haven't made any investments beyond that. We are open to it, but skeptical is not the right term. It's just that, as you probably know, there's a lot that goes into it, and especially if we want to be helpful partners. And so we can tell someone, yeah, you use a Delaware C Corp or, something here in the US. If a company is in Nicaragua, like I don't know all the ins and outs of Nicaraguan law the way we do in the US. So for us, it's got to be an A+++ and everything else, because we know there's going to be some complexities with the international front, security, currency, etc. We looked at a deal very carefully. It was a South African deal, and we really liked the deal a lot. But we decided ultimately that if the deal was in the US, we probably would have said yes. But because of the added complexity of the international scope, in this case, we said no. I think in future funds, we may open up that aperture a bit, but for us, unless we know that we can create an unfair advantage, really get behind the company and help them, and it's got all the A+ boxes checked, we'd rather just pass because we have enough deal flow to say yes to the absolutely most exquisite ones.
Along those same lines, is there anything that you strictly do not invest in?
Yeah, well, certainly if there's something that is, morally reprehensible, we're not a bunch of prudes, but we're not, something that we think, again, is going to harm the world or society, we will not do. We're not, politically driven in either direction, so that, I think if it was a really aggressive, political stance in either direction, we'd probably pass. Generally speaking, and again, there's always, room to explore, but we don't invest in things that have hardware. Hardware, it creates a whole new level of complexity, manufacturing, inventory, supply chain.
Yeah.
Um, uh, so we don't do that. So anything with a physical component is generally a pass. And then also things that have a real long time horizon or that are deeply capital intensive. So if the plan for capital is, yeah, we're doing a $3 million round now, then the next one's going to be 30, the next one's going to be 300, then we're going to need to raise $1 billion. Good for someone else, not good for us. So we look at deals that are capital efficient, that are time efficient. Again, that we can preserve our 3 to 5 year time horizon. Not inventory because hard goods, because inventory, storage, all that, it becomes a problem. Also, B2C, we would consider it. But if the strategy is, we need to go get 1 billion users, it's a winner take all market, we got to have a Super Bowl ad. Those are things that just are against the grain with our philosophy.
Got it. Do you entertain safes or do you go straight to equity?
We entertain safes. Yeah, I mean, depending on where a company is, we've obviously done both price rounds and convertible debt. There are, of course, many templates in there. We don't invest in uncapped safes ever. So if we only invest where we can peg a value with a cap. And then there's another number of other investor provisions that we kind of demand in a safe.
One more question. What is your take that on the opinion the VC funds world is overcrowded? And do you think that this is a risk?
Um, I think there may be some overcrowding. I think we're at a pivotal moment. We're at an inflection point in the world, not just in venture, but in general. And the companies that are really committed to doing things a certain old school way, I think are going to really suffer because they're not sort of evolving with the times. So I think what's going to happen over the next few years is that maybe some of those older school funds are going to struggle a bit. Their methodologies aren't applicable to the sort of current velocity and pace of change, and they may wither away. And then other entrants who have a little bit more kind of future forward look may come and take their place. I actually think that funds of our size are better equipped to deliver long-term returns. Big funds are very notable and such, but as mentioned, it's a big burden. If you're sitting on, your newest fund is $4 billion, and you got to do another $6 billion next year. It's a lot of capital to deploy, and I see again this tendency to over deploy, to put in higher risk deals, and I think these funds in our zip code are nice because it's not a one person fund. It's out of someone's basement. It's got real structure and rigor to it, but it's also not so big that they're under enormous pressure to deploy.
Uh, a number of people have asked, so I'm gonna take the liberty and say when we share your deck with everyone, they're interested in getting in touch with you. So your email or contact information would be helpful to be included if you're open to it.
100%. Yeah, it will be included. And I'm just going to actually stick in the chat here if I can.
Yeah.
Can I post to everybody? Let's see.
I believe you can. If you cannot, I can make sure that everyone gets it.
Okay, so I just put my email address in. Here's my mobile number. Again, we're just super transparent and easy to get to. And feel free to ping me anytime. I'm happy to sit down and have a one-on-one, and we can walk you through everything from the FYI to the growth playbook to look at specific deals or anywhere in between.
Just keep in mind your time zone. You're in Michigan?
I'm in Detroit, East Coast time zone. Most people don't know that, but fun fact, East Coast time zone.
Yeah, I don't even think I knew that. Wow. Okay. Last question from me. How do you want Mudita Venture Partners to be remembered?
Thank you. We are, very passionate about this work, not only to make money, but to make a difference. And I know it sounds cheesy, but we really mean it from the heart. And so I hope that we are looked back at, many, many years from now as a fund who had the courage to do things differently, as opposed to just subscribe to conventional wisdom, that we were pioneers in a new way of doing venture. And that new way involves maximizing returns and minimizing risk, of course, but also, it involves driving impact in the world. There's so much good that can be done with a successful company. Jobs created, environmental impact, impact to society, hours saved, jobs created, on and on and on. And so I hope that we're looked back as this really interesting balance of pioneers that were willing to do things new and differently, people that did the work instead of just, check the box. And in doing so drove both outsized returns and outsized impact. And I hope that it's a legacy fund, that we're able to create an institution that transcends me personally or my brother or any of the other current team members. I hope that 50 years later, Mudita is still, or 100 years later, is still in place, but evolving. And I really hope that the Mudita we see today will be put out of business with the next version and the next version, because I think core attribute is the willingness to reimagine and rethink and reinvent.
If you don't mind, I have one more from my favorite club member, Kim Carter. He loves your attitude towards risk, and he's wondering if you could expand a little bit more on how you mitigate it.
Yeah, I mean, it's a multi-pronged strategy of risk mitigation. It's looking at everything from deal terms and valuations. Mentioned we just passed on a pretty good deal that the valuation was too high. We model out multiple paths to liquidity. So we're never doing a deal where we're overly reliant on a particular buyer or even a particular buyer asset class. We also look for off ramps. So this is the best case, everything goes great. What happens if it doesn't go great? Where can you gain liquidity instead of running it into the ground? We manage risk through that Mudita clinic, which I described earlier, which is that we have a prescriptive intervention when a company is struggling to get it back to organizational health, because no one wants to take a zero or a loss. And so if there's a way we can boost that, we will roll up our sleeves and dive in, whatever has to be done to make that happen. As mentioned, we have a structural component where there's a single member veto on the investment committee. We beat each other up on that in a good way, with lots of love and respect. But it doesn't only mean, by the way, that the veto is a kill or no, or like a go or no go. I'll give you an example. In Fund One, there was a deal that one of my partners liked more than I did. And I was worried that the company was going to require way more capital than the entrepreneur was thinking. They weren't lying, but they maybe couldn't see it. And so I didn't want to be in the richest guy in the room scenario where we're the biggest investor, we're the lead, I just could see it. We're going to be getting all these calls. Oh, I need some more money. I got to make payroll. And we didn't want it to be a leaky bucket. So I said to my partners, I said, I am a veto if we are the lead. I am not a veto if you can get a different lead. And so that spurred a conversation. It wasn't acrimonious, of course not. They ended up getting a lead from a much larger international fund that actually had some strategic value to the company. We put in money and the company thrived. And so it was that dialogue around a veto that we ended up still investing, but we did it under terms that were more favorable, and it helped mitigate risk. So if you'd like to chat more on risk, I'd be happy to chat one-on-one. It's one of my favorite topics because it doesn't mean there's no risk. Obviously, we're in a business of risk, but it's how do you effectively mitigate that risk while still optimizing returns?
I thank you for all of this. I think that you definitely helped me understand what venture capital is with a soul. I am. We've gone through all of our questions that we received from our audience as well as our own questions. So if there's nothing else to add, I think we will end our video.
Great. I'll just say real quickly, thank you. Thanks everybody for your time today. I know everyone's busy. I appreciate you taking a look at our fund. I don't know if my text came through, but my email is just josh@joshlinkner.com. You can also do josh@muditavp.com. Mudita VP is our website. So josh@muditavp works great. And also my mobile number, in case you want to give me a buzz or a text, 248-760-1398. Thanks so much. And I'm just wishing everybody a tremendous amount of Mudita.
Thank you, Josh. It was great talking to you. And thank you all for joining us. We will share the doc soon. Bye-bye.